Welcome to the Deep Dive.
So this week feels like the market isn't just hitting record highs. It's kind of bracing for a showdown, wouldn't you say?
Oh, absolutely. We've seen another, incredible run. Mega cap tech, AI. There's still the rocket fuel.
Yeah, pushing the S&P 500, the SPX towards 6,600. But I don't know, beneath that surface excitement, there's this tension.
There really is.
Yeah.
It's a fascinating mix. You've got this incredible momentum, but then you also hear these whispers of caution.
Exactly. And it's a complex picture for sure.
While the SPX is making these impressive gains, you've also got gold hitting fresh all-time highs. That's your classic safe haven play.
Right.
And that, to me, immediately flags some underlying anxiety. It's like investors are celebrating, but maybe hedging their bets a little.
Celebrating with one hand, hedging with the other. I like that. And that tension is exactly what we're diving into today.
Yeah.
Because our central focus, you see, is the event of the week, the Federal Reserve meeting. It's coming up Wednesday, September 17th.
Not just another meeting. No, this isn't just some item on the economic calendar. It feels like a pivotal moment.
Yeah.
So our mission here is to unpack what it means for major assets, like the S&P 500, and of course, Bitcoin BTC.
Right.
We want to arm you with some clear action plans, give you the critical context from the latest analysis, basically get you informed quickly about this really key financial event.
Yeah, it really feels like the linchpin for whatever comes next. And that contrast you mentioned, record highs versus safe haven demand, perfect setup.
Okay, so let's unpack this weekly market pulse then. Let's set the stage.
Right.
On the surface, the past week looked pretty strong, didn't it? Major indices did well. S&P 500 up, 1.6%?
Yep, solid.
DDIA, the Dow Jones, gained 1.0%, and the Nasdaq led the way again, up 2.0%.
Tech heavy as usual.
And no big surprise, mega cap tech, the AI names, they were firmly in the driver's seat. Feels like the good times just keep rolling.
It does feel that way, but you got to look a bit deeper, right? Beneath those headlines, the economic sands are definitely shifting. Well, for instance, the U.S. 10-year Treasury yield actually dipped. It tested the 4% level after the August inflation data.
Okay.
And what's interesting there is, bond yields usually fall when investors expect slower growth or maybe lower inflation. So that's kind of a subtle counter-narrative to the booming stocks.
Well, good point.
And then over in Europe, the ECB, the European Central Bank, they hinted their rate-cutting cycle might be done. That has its own ripple effects, for global money flow, currencies.
Right, the bond market signaling something different. And it wasn't just economics making waves, was it? There were some geopolitical undercurrents, too.
Yeah, a few things bubbling up. Can't ignore them, even if the market hasn't reacted hugely yet.
Like the resignations in Japan, Prime Minister Ishiba, and in France, Prime Minister Bayrou. And Mexico slapped that big 50% tariff on Chinese cars. Seems like you're aligning more closely with the U.S. on trade.
Yeah, that was significant.
And then there was that Israeli strike in the Middle East. Made headlines, definitely. But crude oil prices, they stayed pretty capped despite the tension. What do you make of that? Crude staying steady.
Well, it suggests that maybe underlying demand factors, or perhaps just a feeling that there's enough supply out there, are outweighing the immediate geopolitical risk fears in the oil market right now.
Okay.
It's just another layer of complexity. It hints that, yeah, tensions exist, but they haven't really hit supply concerns hard. Not yet, anyway.
So all these things, economic shifts, geopolitics, they're kind of converging, building the anticipation for the main event.
Exactly. Which brings us squarely to Wednesday, September 17th. For investors like you listening, this day is, well, it's the single most significant event on the calendar this week, no question.
It's a triple threat, really.
Yep.
You've got the Fed's policy decision itself.
Yep.
Then the FOMC dot plot, always closely watched for future rate projections.
Crucial.
And of course, Chair Powell's press conference afterwards. That's where the nuance, or maybe new uncertainty, comes out.
And the market's expectations, they're running pretty high for this one. Right now, the consensus seems to be expecting 25 basis point cuts at all 3 remaining meetings in 2025.
Okay, so 3 cuts this year are still expected.
Yeah, but here's where it gets interesting, maybe a bit concerning. Calls are growing louder for a more aggressive move, like a 50 basis point cut, specifically in September.
50 basis points.
Yeah.
Wow. That feels like a big shift.
It is. And this is where we need to be really careful.
Looking through the analysis for this, one warning really jumped out at me, a historical parallel that we absolutely have to talk about.
Okay.
One editor pointed out, and it's a stark warning, that if the FOMC delivers a 50 basis point cut and then keeps cutting aggressively, It could be a repeat of 2001, 2007, where it marked to the top of the market and things went downhill from there for a 2-year period. That's a serious historical echo, isn't it?
It absolutely is. And it highlights the key risk. If the market sees those aggressive cuts not as help, but as panic.
Right, as a sign the economy is actually in deep trouble.
Exactly. That could trigger a really significant downturn. That historical context is vital for perspective right now. It all hinges on interpretation. Are the cuts preemptive, stabilizing, or are they a reaction to something bad the Fed sees coming?
So interpretation is everything. And leading up to Wednesday, are there any specific data points we should watch?
Yeah, a couple of key reports that could definitely sway sentiment before the Fed speaks. On Monday, we get the New York Fed Manufacturing Survey.
Okay.
And then Tuesday, U.S. retail sales. Those could easily shape the market's mood going into Wednesday. Any surprises there could amplify the volatility.
Good to know. Okay, let's pivot to the S&P 500 then. How's it looking heading into this Fed decision?
Well, even though it's pushing towards 6,600, the weekly sentiment, according to our sources, is described as toppy.
Toppy. So feeling like it's near a peak, suggesting caution?
Precisely. And the fear and greed index, it's sitting at 54, which is technically neutral.
Neutral, okay.
But remember that gold hitting all-time highs? That signals an underlying fear, or at least anxiety, even while stocks lean optimistic. It's like you said, one foot on the gas, one on the brake.
A perfect description. So technically speaking, what levels are traders watching?
Key levels to watch. On the upside, the next resistance points for the S&P 500 are around $6,684 and then $6,784. Those are the ceilings.
Got it. Resistance at 6,684 and 6,784. And support.
On the downside, the important support levels, the floors, are at $6,460 and $6,360. Breaking below those could signal a more serious pullback.
6460 and 6360. Okay. Critical thresholds then.
Definitely.
So for you listening, trying to navigate this, what's the pre-FOMC game plan?
Well, the advice leans towards caution. Maybe think about reducing the size of any new long positions. Be really selective.
Makes sense.
Keep a close eye on those resistance levels we mentioned. Could be spots for taking some profits. And definitely tighten your stop losses on existing positions.
Yeah. Protecting capital seems key with volatility almost guaranteed.
It is. Now, if we connect this to the bigger picture, for FOMC day itself and afterwards, there are basically 3 crucial scenarios for SPX traders to have in mind. Think of these as your playbooks.
All right, let's break it down. Scenario A. What if the Fed does go for that aggressive 50 basis point cut? You mentioned the 2001-2007 parallel. What would confirm that bearish turn?
Okay, so scenario A, the aggressive cut. This outlook is highly bearish, a real flashing red light. The market likely sees this as the Fed admitting serious economic trouble.
Right.
To confirm it, you'd look for broad-based selling, not just tech profit-taking, but selling across multiple sectors. You'd also probably see a sharp rally in bonds, long-term bonds, and gold that flight to quality.
Gotcha. So the action plan.
Strongly consider reducing or even closing long positions, maybe even initiating short positions, SPX futures, inverse ETFs, something like that. Priority 1 becomes capital preservation, maybe even profiting from the downside.
Okay, that's the brace for impact scenario. What about the middle ground? Fed meets expectations.
That's scenario B, the expected 25 basis point cut, delivered with a reassuring tone from Powell. Here, the outlook is more neutral, maybe leaning bullish.
Okay.
The market might just see it as a controlled adjustment. The broader trend could continue, or maybe we just consolidate for a bit.
And the action there.
Look for that upward trend to continue towards resistance. Maybe look for chances to buy on dips, those pullbacks towards support levels. This is kind of the sigh of relief scenario for the market.
Makes sense. And the third one, where they cut but they sound worried. That sounds tricky.
It is tricky. That's scenario C, a 25 basis point cut, but Powell sounds cautious, maybe highlighting that stagflation risk we'll talk more about.
Right. Stagflation.
The outlook here is mixed, leaning bearish. It's driven by signs of a softening labor market, which we are seeing, combined with that sticky inflation. That could definitely make Powell sound less confident even while cutting.
So what's the play then?
Expect more volatility, potential pullbacks, maybe consider some short-term hedging. Or just hold off on new long positions until the dust settles and there's more clarity. The market might worry the Fed doesn't quite have a handle on things.
Okay, 3 distinct possibilities. But no matter what happens,
risk management is absolutely paramount. Expect swings around that 2 p.m. announcement on Wednesday. Use your stop losses, always. And adjust your position sizes based on conviction and volatility.
good reminder. The market doesn't care about your feelings, only your plan.
Exactly. Now let's switch gears to Bitcoin, BTC. Its path seems even more explicitly tied to what the Fed does with rates, right?
Absolutely. The FOMC meeting is arguably its primary driver right now, maybe even more than for traditional stocks. It's a risk asset, very sensitive to liquidity.
And like the SPX, Bitcoin has key levels everyone's watching. On the upside, the next major resistance points are $117,000 and then $125,000. Those are the big ceiling.
117K and 125K.
And support. Support levels are down at $103,000 and $92,000. Those are the critical floors. And you mentioned it breaking above 125K. That could send Bitcoin into uncharted territory, price discovery mode.
Meaning no historical levels to lean on, just pure supply and demand.
Exactly, just reacting to new dynamics.
So pre-FOMC, what's the strategy for Bitcoin traders?
Keep a very close eye on those Fed rate expectations. They're like Bitcoin's lifeblood right now. Watch how it holds that immediate support around $103,000.
Okay.
If 103K holds and the general vibe leans towards multiple cuts, maybe consider small, speculative, long positions. But always, and I really mean always, with extreme caution. Its volatility is no joke.
Understood. Now, for the FOMC day scenarios for Bitcoin, let's start bullish. Scenario A, Fed confirms 3 rate cuts this year. What happens?
This would likely be a strongly bullish trigger. Our sources suggest we could see Bitcoin push right through that 125K resistance and enter price discovery mode, just like we discussed. New highs.
So the action plan.
Look for that breakout. Consider starting or adding to long positions.
Yeah.
Use those support levels, 103K, maybe 92K, as your stop loss areas. The logic is simple. Cheaper money often flows into riskier assets like crypto.
Makes sense. And the flip side. Scenario B, Fed signals fewer cuts or sounds cautious, maybe even hawkish.
That points to a bearish outlook for Bitcoin. Could lead to significant downside pressure.
Or those support levels.
Yeah, be prepared for a potential move down towards $103,000, maybe even $92,000. In that case, it'd be smart to think about taking profits on existing longs or just stay on the sidelines, avoid new entries until a clear bullish signal appears.
Got it. Tighter money equals headwinds for risk-on assets like Bitcoin.
Precisely. And again, risk management is critical here. Fed news can cause massive swings in Bitcoin. Stop losses are non-negotiable. And remember, while it's tied to the Fed, it's also influenced by broader market sentiment, how stocks are doing. It's a complex beast.
Definitely. Okay, let's zoom out a bit beyond the Fed. What other broader economic and corporate insights are shaping things?
Sure. On the economic front, we got the August Producer Price Index, the PPI. It actually cooled off, showed its first negative month-over-month print since back in April.
Oh, interesting. Why?
Mostly due to softer costs for energy, food, and trade services. So that's potentially good news for businesses. Suggests maybe some cost pressures are easing up.
Okay, but what about consumers? The CPI.
Yeah, the August Consumer Price Index, CPI, told a slightly different story. It came in, quote, hotter, but mostly in line.
Meaning inflation is still sticky?
Exactly. Still stubbornly above the Fed's 2% target. So maybe some relief for producers, but consumers are likely still feeling the pinch.
And this is where it gets really interesting for the Fed, right? Because the labor market data has also been telling.
Very telling. Initial jobless claims jumped highest levels since 2021. And critically, the Bureau of Labor Statistics, the BLS, put out revisions showing roughly 76,000 fewer jobs per month were created over the last year than they first reported.
76,000 fewer per month. That's a big revision.
It's not insignificant. And if you connect the dots, you've got growing evidence of a softer labor market, right alongside that sticky inflation we just talked about.
Which points directly to
Stagflation risk. That's the worry. Slowing growth, maybe even stagnation, but inflation stays high. That combination could really temper Powell's tone next week, even if they do cut rates. It complicates their job immensely balancing maximum employment and price stability.
softer labor plus sticky inflation equals stagflation risk. Definitely complicates the Fed's playbook. Now, shifting to the corporate side, Oracle had results.
Yeah, Oracle's results were pretty much in line. But the real headline grabber was this jaw-dropping 359% surge in RPO backlog to $455 billion.
RPO. Remind us what that is.
Remaining performance obligations. Basically, it's contracted future revenue. And that number isn't just huge. It tells you something important.
Which is?
It shows that even with economic uncertainty swirling, companies are making massive long-term bets on AI infrastructure. This sustained spending on AI, it could actually be a factor, pushing back against potential recessionary forces elsewhere. It's a unique resilience in that specific tech sector.
Fascinating insight. Big long-term AI commitments. What else happened in corporate news?
A few other notable things. EchoStar shares popped after they sold some spectrum to SpaceX to help boost Starlink broadband. Shows that satellite connectivity demand is still hot.
Okay.
Apple, of course, unveiled the iPhone 17, new ultra-thin iPhone Air model, and a 10% price hike on the Pro version, though it comes with more storage. Speaks to their pricing power, which the Fed watches regarding inflation.
Right. Any M&A or activist news?
Yep. Bill.com got a new activist investor, Elliott Management, disclosed a stake. That often means pressure is coming for changes. And Warner Brothers Discovery shares climbed on those reports of a potential takeover led by Skydance and Paramount, although other bidders might pop up. Lots of moving parts.
Definitely a dynamic corporate scene.
For sure. And just a reminder for you listening, beyond the Fed on Wednesday, keep an eye on other events next week. Thursday brings initial jobless claims again, plus the Philly Fed manufacturing survey. More clues on labor and regional activity.
And earnings, too, right?
Yeah, we get earnings from big names like FedEx, homebuilder Lennar, and Darden Restaurants, owner of Olive Garden. Those give you a real ground-level view on shipping, housing, and consumer spending. The news flow doesn't stop Wednesday.
Good point. Okay, so let's bring it all together. Let's talk about taking action, specific opportunities, and managing risk this week.
All right. First, just hammering the general risk management point one more time, because it's that important.
Go for it.
Use defined stop losses. Always. Be ready to adjust your position sizes based on how sure you feel and how much volatility you expect, especially around the FOMC. Don't be afraid to take some money off the table if things move against you.
Sound advice.
Yep.
Now, for specific opportunities, our sources flagged a few stocks to watch.
Yeah, a few ideas, keeping that volatility in mind. First is Mueller Water Products, ticker MWA. They do water infrastructure stuff. The idea is to buy near $6.15, target a sell around $6.65 with the stop loss at $5.65, kind of an infrastructure resilience play.
MWA. Okay, next.
Archer Aviation, ticker ACHR. They're in that electric vertical takeoff and landing aircraft space eVTOLs. It's speculative, definitely high growth potential though. For ACHR, the suggestion is buy near $6.75, aim to sell at $8, stop loss at $5.50.
ACHR, the eVTOL play.
Uh-huh.
And the third one.
Flux Power Holdings, ticker FLUX. They design and make lithium-ion energy storage like industrial batteries. For FLUX, the idea is buy near $1.70, sell target $1.90, stop loss $1.50.
FLUX, energy storage. So MWA, ACHR, FLUX, specific ideas to consider, but obviously do your own research. They all carry risk.
Absolutely. Standard disclaimer applies.
And looking at broader sentiment again, that fear and greed index is at a 54, neutral. But like you said, it's worth repeating. Stocks and options might lean greedy, but that gold demand shows underlying fear. And with FOMC hitting Wednesday at 2 p.m. Eastern, expect volatility to ramp up. Even the U.S. dollar index, the DXY, is showing a pattern.
Yeah, it's tracing out what looks like a descending triangle. That pattern often hints at a potential breakdown, maybe below $98.80, especially if more rate cuts look likely. That could be another big signal for markets.
And a weaker dollar could potentially help commodities, maybe even risk assets.
Could provide a tailwind, yeah, if that rate cut story really takes hold.
Okay, so wrapping up this deep dive. The Fed meeting this week is absolutely critical. It's going to shape the direction for the SPX, for Bitcoin, probably for everything.
No doubt.
Having those action plans ready for the different scenarios isn't just smart. It feels essential for navigating what could be a pretty turbulent week, but maybe an opportunistic one too.
Absolutely. And that leaves us with a final thought for you to chew on. Given those historical parallels we talked about, 2001, 2007, and this growing stagflation risk, how is the market really going to interpret the Fed's message next week?
Is it just a necessary adjustment for a basically healthy economy?
Or is it that flashing red light, warning of deeper trouble ahead? Which scenario do you think is more likely, based on everything we've discussed? And maybe more importantly, how will you position yourself for that interpretation? Something to think about.